There's loads going on in markets at the moment, so much we can talk about. So let's jump straight in. Focusing first on the Middle East. The ceasefire there is certainly fraying at the edges, perhaps not fully unraveling as of yet, but you'll probably have woken up to headlines along the lines of oil spiking as a result of further strikes in the region. And that's true, of course, but it's worth having some perspective to that. Oil's around about $94 a barrel as we're recording this. And so it has gone up a little bit, but the overarching theme over the last few weeks has actually been oil sort of coming off its recent highs. It was only a month or so ago, it was in the hundreds. And in fact, you know, it's still some way below the levels it reached in 2022. So perspective, as ever, is quite important. There's no doubt, of course, that this increase in oil price has created an inflationary impulse around the world. And the real difficult decision that central banks are facing now is whether to act on this inflationary impulse, this headline inflation, which is coming through from that oil price increase. And it's firmly sort of coming through in the numbers today, not necessarily in terms of core inflation. We haven't had a pass through yet, but certainly in terms of headline numbers, or whether to sort of worry more about the potential impact in terms of economic growth from this uncertainty, from these price rises that may sort of dampen overall aggregate demand. And the big risk in all of this, of course, is that sort of stagflationary risk where economies don't really function particularly positively, and you have inflation on top, which is the sort of ultimate conundrum for central bankers. We've got the European Central Bank decision. They will be the first central bank of the majors to put interest rates back up 25 basis points. That's broadly in the price, and perhaps to be expected. The ECB has a bit of a reputation of being sort of very rules-based, sort of more dogmatic perhaps than pragmatic. Famously, they put interest rates up twice as we were entering the financial crisis. And so, you know, there is some form on this topic. The Federal Reserve, perhaps in a very different position. They've got a dual mandate for a start. They've also got a new chair and a president who's sort of very vocally trying to talk interest rates down. Bank of England perhaps somewhere in the middle. Maybe the main difference between the ECB and Bank of England and the Federal Reserve is the latter two only really have one economy to worry about, whereas the ECB has a large number of very disparate economies to try and sort of look after in their stables. So we'll see how it all pans out. But clearly inflation has gone up and the risk of interest rate increases has, of course, gone up too. As ever, it's an unenviable job being a central banker, and this period in particular will be a challenging one for them to navigate. The market response generally has been sort of mixed. Equities remain, you know, relatively well supported. You can argue that they're focusing more on earnings, more on profitability perhaps than macro news, whereas fixed income perhaps reflecting more of these concerns out there. To give you some color on that, equity markets year to date, the US is around about 6 or 7% up. UK's up around about half of that. Europe's lagging a bit. We're having some great results so far year to date out of emerging markets, out of Asia, ex-Japan. You may have seen Korea's doing, you know, incredibly well, not least on sort of tech-related performance. Even Japan up 25% in sterling terms year to date. So there are some pockets of really strong performance despite this news flow in equity markets. We can look below that and you can see this theme of market rotation, which we've spoken about in a couple of these recent videos, continues in quite a sort of strong way. Let me give you some feeling for that. For example, the Magnificent Seven, very much the sort of bellwethers of the last couple of years, massive mega cap tech names growing really strongly and pushing their valuations up materially over the last sort of few years and driving the index up as a result of that. They've actually come off their recent highs. They peaked not that long ago, and they're about 10% off those highs in relatively short order as it happens. It's only back to the sorts of levels you saw in November, so it's not sort of undoing loads of gains, but it's interesting to see tech down now year to date a couple of percentage points. The Magnificent Seven, crucially, down a couple of percentage points year to date. Having said that, though, the US has still been relatively strong, and that's been driven actually by smaller companies. So if you look at the 2,000 sort of smaller companies, in the US. That's actually up around about 15% year to date. So that rotation away from large cap to smaller companies, which are still large in the US by any sort of conventional measure, really, that's firmly in play. And sticking with large cap, even the equally weighted exposure to the US, which is designed to sort of dial down the concentration you get in market capitalization weighted indices, that's actually outperforming the market cap index year to date as well. So despite the fact you've got a decent return out of the US, 6-7%, equally weighted exposure of that pulls you down the cap scale, that's actually doing better as well. So this rotation in equity markets is very firmly in play in recent weeks. Fixed income is showing more concerns around the macroeconomic environment and indeed the inflationary risks. Yields have gone up over the course of the year, but we need also to have a bit of context around that. Yields peaked and have actually come back in recent weeks. They're near to their recent highs, but they are off their highs. So again, just reflecting the fact that you've had this concern, markets have reacted to it, but they've started just to dial back on some of that risk. In government bond land, that risk aversion and indeed concern around inflation has sort of demonstrated itself in increases in yields. But I think some context is relevant here too. We're certainly off the highs year to date in terms of where the yields have settled. The US is around about 4.5% on the 10-year. It got up to 4.7 not too long ago. UK's done a similar move down to 4.9, having peaked around about the sort of 5.1, 5.2 levels. So, we have come off the top in terms of those yield levels. They're still high and certainly higher year to date, but they have come off the top somewhat over the course of the last few weeks. Just a quick reflection on the gold price. Gold is often thought as being a sort of safe haven, a place where you park capital when risk aversion goes up. It's also often thought of as a bit of an inflation hedge. So you would expect gold to be sort of tearing away over the course of 2026. We've got both risk aversion and inflation. It's actually down year to date, interestingly enough, perhaps reflecting more the fact it did very well over the course of 2025, and perhaps there's a lot of good news in that price already. Of course, we have to talk about these mega cap tech IPOs that are coming up. The most proximate one, of course, is SpaceX, which is, I think the price is going to be struck today. Rumors are it's 4 times oversubscribed, and on that basis, it's likely to IPO with a market capitalization of about $75 billion. That would be the largest IPO in history. But it's worth bearing in mind how small $75 billion is in the context of the broader business. On that sort of valuation, which, by the way, would be about 100 times revenue, not profit, which is, punchy to say the least, that would imply an overall company valuation of about $1.8 trillion. It's an extraordinarily massive business. And of course, a lot of good news sort of factored in from the future there. It's sort of almost reliant on a lot of these sort of still long in the future projects really sort of coming to fruition to justify that sort of valuation. So it's a big deal, big ticket, and will of course occupy a lot of headlines over the course of the next few weeks. We've also got Anthropic and OpenAI coming in relatively short order too. So there's going to be some big changes at the absolute sort of zenith of the US stock market as these big names sort of come through. Depending on your view of these, you can make a very positive case for that, or arguably quite a negative one. On the positive side, of course, you've got these new names really sort of capturing the public's attention, may also bring new entrants into the market, bring new capital into the market, and almost sort of act as a catalyst to get markets going again. On the other side, of course, you can argue that the pool of capital won't expand that much, and if that's the case, then essentially what they're doing is sort of sucking in capital from elsewhere, which put pressure on valuations in other parts of the index in order to fund an allocation to these names. That will only be able to be judged with the benefit of hindsight, of course, and foresight is not something we have a huge amount of as humans, and certainly not in markets. And so without the benefit of foresight, the question is, of course, how do you navigate those two very different potential sort of scenarios? Well, ultimately, to us, it boils down again to our old friends of diversification, patience, disciplined long-term investing, and also, of course, bearing in mind valuations when you're allocating capital, trying to avoid areas that are excessively priced and look for ones that are more attractively valued, because there's less good news in the price, less scope for disappointment, arguably, and a combination of diversified, reasonably valued assets should be, over the long run, rewarding way to invest. That's it from me. Have a great weekend when you get there, and we'll see you next time.